Okay, so in this video lecture, so we will be talking about multiplier still in module 7. Okay, so this is the last topic under our module. So when we say multiplier in economics or in the field of economics, it refers to an economic factor that when increased or changed, it causes also increase or changes in many other related economic variables there is. Okay, so this is a factor that is being used. So in terms of GDP, the multiplier effect causes gains in total output to be greater than the change in spending that caused it. So it is something that causes change or increase. In this case, for the GDP, the factors that it affects are the gains in total output and the change in spending. Okay. So the term multiplier is usually used in reference to the relationship between government spending and the total national income. So multipliers are also used in explaining fractional reserve banking, known as the deposit multiplier. Okay, so as we go along, we will discuss the different types of multipliers. So multiplier is simply a factor, okay, that amplifies or increase the base value of something. So in our previous slide, we've mentioned the two factors, if you could still remember. So a multiplier of 2 times, for instance, would double the base figure, okay, from the term multiplier, multiply. Okay, so multiplier of 0.5 times, on the other hand, would actually reduce the base figure by half, okay, because this multiplier doesn't actually increase because it's not even more than 1. Okay, so there are many different multipliers that exist in finance and economics, as mentioned earlier. So the first multiplier that we have is the fiscal multiplier. So the fiscal multiplier is the ratio of a country's additional national income to the initial boost in spending or reduction in taxes that lead to that extra income. Okay, so how does fiscal multiplier works? So we have here an example. So for example, a national government enacts a $1 billion fiscal stimulus, and that its consumers' marginal propensity to consume is 0.75. So consumers who receive the initial $1 billion will save $250 million, and they will spend $750 million, effectively initiating another. Okay, so here, this is so because if you could notice, the MPC of the consumers is 0.75. So therefore, if there is a fiscal stimulus that is being given, so they would spend 75% of that and save 25% of that. Okay, so the recipient of that $750 million will spend 562.5 million and so on. So meaning to say here, how much does 562.5? Okay, that's also 75%. Meaning to say every time that they receive something, 75% of that will be spent for consumption and 25% will be saved. That's how it works. Okay. So the next is we have the investment multiplier. So here, the investment multiplier, it similarly refers to the concept that any increase in public or private investment has a more than proportionate positive impact on the aggregate income and the general economy. So here, the multiplier attempts to quantify the additional effects of a policy beyond those immediately measurable. So here, the case is if there is a larger investment multiplier, there is more efficient, okay, in creating and distributing the wealth throughout the country. So here, unlike that of the first multiplier that we have mentioned, the fiscal multiplier, under the investment multiplier, we just uh, quantify, okay, the additional effect of the policy. Okay, so here again, um, the larger it is viewed that as the investment becomes larger, or the investment multiplier becomes larger, there are more the more efficient it is at creating and distributing wealth throughout the country. Okay, so this is how investment multiplier works. For the third type of multipliers, we have the earnings multiplier. So the earnings multiplier frames a company's current stock price in terms of the company's EPS, or earnings per share. Okay, so earnings per share is net income divided by the shares outstanding. Okay, normally this can be a basis for the market value of your shares uh, when offering it on public, and it could also be together with other factors as well. Okay, so but earnings multiplier again is for a company's current stock price. So it presents the stock's market value as a function of the company's earnings, and is computed as, okay, price per share divided by your earnings per share. Okay, so again, this one, or to continue, I mean, this is also known as the price to earnings ratio. So mean to say, if or it can be used as a simplified valuation tool for comparing relative costliness of the stocks of a similar company, and for judging the current stock prices against their historical prices on an earnings relative basis. So here, you will also be able to correlate, or uh, link the relationship between the price, the market price of your stock, and the earnings of the company. Okay, whether it's actually a balance, or it doesn't follow that if your earnings is higher, then your market price or value is also higher in terms of this ratio. Okay, so this is how your or earnings multiplier also is being used. Okay, so the next multiplier is equity multiplier. So here, this is a commonly used financial ratio that is calculated by dividing the company's total asset by their total net equity. So this will measure our financial leverage. Okay, when we say financial leverage, this normally is related to uh, the sources of funding. So sources of funding for a company may be from their shareholders in the form of their capital being contributed, or from long-term liabilities from our creditors, in which we or the company, I mean, takes a loan or long-term debt. Okay, so in this case, since it is equity multiplier, so we focus more on the net equity. So we measure the financial leverage that is being contributed by the owners to the company's assets. Okay, so companies finance their operations with equity or debt, as mentioned. So a higher equity multiplier indicates that there is a larger portion of asset that is being financed, uh, that a larger portion of asset financing is attributed to um, the debt. Okay, so this is how we use the equity multiplier. Again, if there is a higher equity multiplier, so meaning to say assets are greater. Okay, for example, if your equity multiplier is 20, so meaning to say 20% of the asset is only is from the owners and 80% are coming from the creditors. So that's why it is said that it indicates that a larger portion of asset is being financed by the creditor. So this is not a good indication, meaning to say our company is just continuing to exist because of our borrowings. Okay, when in fact it should be uh, the claim of the asset should have to be mostly for the owners. Okay. So the next is, okay, the equity multiplier is thus a variation of the debt ratio, okay, in which the definition of debt financing includes all liabilities. I mean to say here, um, under the debt ratio, we consider not only the long-term debt but also the short-term obligations. Okay. So another is multiplying the money. Okay, so this is one of the popular multiplier theory, and its equations were created by, again, the British economist John Maynard Keynes. So he believed that any injection of government spending created a proportional increase in overall income for the population, since the extra spending would carry through the economy. So there is a, according to his belief or theory, government spending uh, will have the effect of distributing the income throughout the economy. So here, the Keynes wrote the following equation to describe the relationship between the income and consumption as well as investment. So your income, or Y, is equal to consumption plus investment. Or this is also the same with that of the savings. If you could still remember, your income is equal to consumption plus the saving. But in this case, based on Keynes' theory, he differentiated savings from that of the investment. Savings is on the individual level, whereas investment is on the government spending. So this is actually what he is talking about in his theory. So the equation states that for any level of income, people spend a fraction and save or invest the remainder. Okay, so that's how he uh, created, okay, or based his theory. Okay, so that's all for the multiplier.